How's it going, everybody? It's been a while since I've done a video. I've had quite a few people ask me about the market recently. Quite a few nervous people saying they're hedged, people saying they're raising cash. People are worried about the long term. People are worried about the Fed taper, saying it's removal of the punch bowl, and that's going to be immediately a problem for the market. I'm going to share my thoughts. They're going to be a little bit more long term in nature. This is basically what I want to see before I will shift from saying I'm long-term bullish to saying that I'm long-term bearish, or at a minimum long-term cautious, and or more of a neutral stance. First of all, taper is not bearish historically. It hasn't necessarily been bearish. It can be, but historically taper by itself is not necessarily bearish. I don't know if I need to explain what taper is, but taper is not the end of QE. It's tapering of QE. Second, it hasn't even started yet. It starts in December of this year. I don't completely understand why so many people are worried about it just yet. There's plenty of things to worry about, I guess, with the market, and I am getting to the point slowly where I am going to be saying that we need to start to look more closely at some of these things. And I do think there's potential next year for some fairly bearish action in the market. I really do. But I don't think we're there yet. And I'm not seeing any of the typical warning signs just yet that you typically see before major issues. So this market update, I'm not going to go over the short term too much. We did have a recent correction, and people got way too bearish in that correction. And I think we've still got to work that off, which probably means we're going higher. I think we'll probably close the year higher than 4,800s, 4,850, 4,900. I wouldn't roll out either. Seasonality is still strong. There's still a lot of people fighting this market. There's a fairly substantial wall worry still in place. I'm still bullish here. I'm still positioned for more upside. I have not reduced my long exposure yet, like I did prior to the September pullback we had, and a few other times I have this year. That's the short term. That's where I'm at. I'm not going to focus too much on that. What I want to focus on is things that we should watch for that have a little bit more predictive power before the bigger events that we see in the market. Now, the way markets work, there is no guarantee that we'll see any of these things before the next big thing. We could have a major sell-off without any of these things happening, okay? The markets are purely probability based, and there is no set of things that you're going to see every single time that guarantees you will miss all the downside. So you have to have a fallback plan, and that fallback plan is just basically price. Like, if the price starts to break key levels, you need to adjust despite not getting the warning signs that we typically get. The warning signs just going to change your probabilities. One of the big things that would drastically change the probabilities, in my opinion, would be a true melt up, a true euphoric state where everybody gets long. And I know people are saying everybody's already long. I don't think so. I still think there's a lot of people fighting this market, and I'm going to show you some evidence of that. We're still not at a true all-in melt-up state. If we did get that, it would drastically change the probabilities. It would make it a lot easier to shift to cash and preempt the selling that will inevitably come in that scenario. But we don't have to get a melt-up to have a bear market, or I shouldn't say bear market, more bearish conditions. We don't have to have a melt up to see a market that has pretty major bearish issues. For instance, 2015, 2016, that was just kind of a big rounding top. And people are going to say that wasn't a bear market. And under the surface, there was some pretty rough stuff that went on in individual stocks. It was a pretty bearish period. It was a long period of sideways in the indexes. And under the surface, there was a lot of turmoil, a lot of problems. A lot of people lost a lot of money that didn't know what they were doing, and that were accustomed to the bull market and thought it would always go up. 2018, in that January top, that was a true melt up. That's what I still think is probably the most probable way that this market will end. because of the amount of QE that we saw this time. It was massive. I think it was several multiples higher than the 2008 QE. And there's still a huge amount of cash on the sidelines. People won't agree with me on that either, but I'm going to show you some real evidence of that, and you can make your own decisions. Anyways, this chart, I'm just showing you QE, or tapering has not even started yet. It's still the normal movement higher in the balance sheet that we've been seeing. Okay. M2, rate of change, it's still an elevated rate of change on M2. The long-term moving average, I did a 700 period moving average on the rate of change. And the most recent monthly data, we're still above that average on M2 growth. GDP, same story. We're still seeing fairly strong GDP growth. This is also monthly data. I put a 12 period rate of change on it. I think something you might see before a slowdown or before major trouble for the market, you might see GDP at least at a minimum stall, the growth stall. We're not seeing that. We're still seeing very strong GDP growth. I've seen some people try to make the argument that we're seeing some weakening in the economy. We're not seeing it in GDP, at least, not yet. You do get some warnings sometimes, not always, but at least before the bigger shocks, you at least see a pretty substantial slowdown in rate of change prior to the bigger issues that we've had. This is just Zacks Investment Research. You can Google this, but times that taper was announced didn't necessarily mean the end of the bull market. Even raising rates didn't kill the bull market. Now, 2015-16, like I said, that was a more bearish period than this chart would suggest. But still, we recovered. And they were tapering all through 2017 as well. And we still had a bull market. So it's not the end necessarily the end. The reason I showed this is why it's so important to play the long game. At least, even if you're a shorter term trader, you should have some longer term investments. And also, if you do want to short the S&P 500, I highly recommend it should be very short term in nature, because there's a lot of people trying to call the long term top and they want to get short and be Michael Burry and be short and get a movie made about them. Rolling 1 year annual returns, the percent positive is 75%. So if you're going to try to hold on to a short for an entire year like he did, you have a 25% chance of actually that working. It's not very good odds, all things being equal. There is some decent edge shorter term on shorting the S&P 500. There's one right now that I've been using a few times. I've used it several times in the last few years. When you have a very high GEX environment and you have the S&P 500 very near all-time highs and you gap up overnight, at RTH Open there's a very high probability of a dump at RTH Open. You can look at the chart the last several months with high GEX. Every time we gap up and GEX is high, there's a pretty good dump right at the open. And it's probably something to do with the options market. I don't know the exact reason it happens, but just some rehedging by market makers, I assume. That's all it is, and it's predictable, and it's an actual edge on the short side. Now, a lot of these guys tell you, don't make any trades at the open. Wait 15 minutes, wait 30 minutes, and no. If you have some kind of edge, it doesn't matter when you place the trade. Like, yeah, I mean, I would say placing a trade right at the close would be a problem, because you're exposing yourself to overnight risk, but there's a big edge right at the open that I just gave you. We had a lot of open interest at the 4,700 strike, and it's not uncommon for the market to pin to those levels. This is anyone interested, Tier 1 Alpha. It's your free gamma tool if you want a free tool to see S&P 500 gamma exposure. Quite a lot of positive gamma at 4,700. A lot of this, I assume, when Monday updates, will fall off. And we have 47.25 as the new high gamma strike. So the market will be more free to move up towards that. PE ratios, of course, have been talked about for forever, and for a long time they weren't super elevated, but they are pretty elevated now. However, I've said it over and over again, I think you should adjust for rates on these. I've done that. So here's the back test. Just looking at the PE ratio, this guy did a back test of it, and yes, there's negative 10-year returns. Just looking at it that way, not adjusting for rates, which I don't think is a fair comparison. This is the rates. This is the Shiller PE 10 adjusted for rates, and even with adjusted for rates, we are getting very high now. So it is a concern. Is it as big a concern? Are the next 10 years guaranteed to be negative? I don't think so. I think the next 10 years are going to be positive, but I do think we're setting up for some turbulence fairly soon, unless earnings really pick up. If earnings continue at the pace they have been, then this will eventually no longer be an issue. But if they don't, and they're projected to not continue the pace that they have been, and then if Fed raises rates, which I'll get to that, but they are projected to raise rates 1.5 times next year. So there's going to be some tightening coming into high valuations. The Fed, I mean, we're back to full employment now. So the Fed will probably end up raising rates to try to do something about inflation. Whether or not raising rates will actually do much when you have so many supply chain issues, whether it'll do much to inflation, I don't know. But people have told me that the Fed will never raise rates again. They're going to raise rates next year, most likely. I'll show you why. This year we've had 55% S&P 500 EPS growth. Now you're comparing it to 2020, so that's part of the reason that the number's so elevated. But there was a lot of worry about this earnings. Several articles that were coming out that third quarter earnings were going to underperform. Well, guess what? Third quarter earnings were way above expectations. And that's part of the reason we're at all-time highs. However, Yardeni, I really like Yardeni because he's a macro guy that's not always bearish. Great data, great charts. So 2021, he projected 50% earnings growth, and we're at 55%. 2022, he's projecting 4.8. Pretty substantial slowdown. Does it show the average? I think that's way below average. I don't know. Anyways, I'm pretty sure that's way below average. It's pretty anemic earnings growth, and it looks like a lot of it's in the back half of 2022. So that is a concern for me, considering the valuations, considering what price has been doing, and considering that they may raise rates. Suddenly, if earnings slow down, it's very hard for these stocks to grow into valuations with earnings slowing way down. So there's a few ways that the market can correct for this imbalance: sideways for a long time, or price. Who knows which one it'll be, but that becomes a fairly likely scenario, is that at a minimum price has to slow way down or go sideways at a minimum. But I think there's a decent chance that you could see quite a bit more problems than just that. Currently, we're at 25 basis points on federal funds rate, and by December 22, they are projected to be 50 to 75. So 1.5 rate hikes next year is already priced in. And I'll tell you, this FedWatch tool, it's been pretty accurate in my opinion historically. So I think there's a pretty dang good chance of Fed rate hikes coming up next year. With the backdrop of high valuations, with the backdrop of potentially people getting a lot more all in than they currently are, we could see some fireworks. I was talking about earlier with cash levels being still pretty elevated. This is what happened with COVID. We had, even prior to COVID, people were stuffing a lot of money in money markets. They were very afraid. You had the yield curve inversion in 19, and a lot of other scary articles came out. You had the election. People stuffed a lot of money in money market accounts, and it hasn't come out yet. this was last updated Q2. So a little bit outdated, but I suspect we haven't seen too much of this come out yet. And I have some more recent ones as well, and you can see the same thing. And this was very recently updated, October, and still a lot of money in money market accounts. This is broken down by category. Most of it's in government money market accounts, but still a lot of cash out there. It's broken down by fund manager. Same chart, just broken down by fund manager. And I've been saying it. A lot of these institutional guys have been bearish and fighting this market the whole way. This is further evidence, and they're still fighting it. Still a lot of cash out there. What happens is even 5% of this cash comes out and gets dumped into stocks. Likely that's people FOMOing and buying the top. Even on the fund manager survey, you're seeing a lot more cash now. I think they're too early yet again. Now, is it historically high? No, but pretty big ramp from the lows. Other thing in fund manager survey is people are very all in on this commodity thing again. These fund managers are. So this whole idea that Russell might continue to outperform, I don't know if we need to stay there anymore. I think now we might see tech start to outperform again, because every time they've gotten underweight tech, technically they're still a little bit overweight tech, but they're way more overweight banks and commodities, which that's Russell. That's pretty heavily Russell. Yes, they're overweight equities as a whole, but I think you might see tech. Tech's been pretty good the last few weeks, and Russell's been pretty weak. You might continue to see that. There's other things you could look at if you want to double check that. Dark pools, you can look at dark pools on Russell 2000 versus tech. I haven't looked at that actually recently, but that's actually been a pretty reliable way to kind of predict the rotations a little bit. Be available bear. This is one of my favorite indicators, like a longer term fear greed indicator, and we have come way off. We were up pretty high not long ago, and it's come way off. There's a lot of fear out there. There's a new wall worry in place, and I think you need to stay on the bull side still. I know I sound like a broken record a lot of times. People call me a perma bull. I assure you, I'm not a perma bull. I just like to make money in markets. I don't like to not make money. And you're not going to make a lot of money always being bearish. But you can... A very important thing for us bulls is to be able to identify when regimes are changing. And I do think we're at the very early stages of seeing some small signs that the regime could be changing next year. Yardini, I don't know if I have this chart in here, but Yardini's year-end predictions for SPX have been pretty accurate actually. And he's projecting 5,200 next year. He's got 4,800 this year, which we have a good chance to finish around there. I think you could see a scenario where we go to 5,200 Q1 of 2022, hit his target, and then we have a pretty severe sell-off the rest of the year, 20% plus. I would not rule out. But before I will say that is for sure, I want to get there first, and I want to see what credit spreads are doing. I want to see what this indicator is doing. I want to see what everything is looking like. I want to see some of that cash come off. I don't have to see all these things, mind you, and we won't see all these things. But I want to see a few of these. I'm not seeing enough yet to run for the hills and start raising heavy amounts of cash long term. But when we do see enough of these signs, especially if you see the melt up, I'm going to completely change the way I trade for probably 6 months to a year or more. And I think that you should have different styles of trading for different regimes. I have been trading much more long-term since we got the shock in 2020 and holding leveraged long index futures. For much of this, I've went cash a few times, went net short even a few times, but it was very brief, and it was intended to be very brief. And the intention was to get back in those long-term longs as soon as I could safely. And that's what I've done. But if we get a 2018, early 2018 style blow off top, from there I'm going to raise cash only when price breaks down, mind you. I'm intending to hopefully be long for most of the run up. It's as simple as maybe even drawing a trend line once you get a melt up. And I'm not a big TA guy, as you know, but draw a trend line under price when we're melting up. We break below that line, I'm back, I'm in heavy cash. And then after that, after we get the shock, I will trade much more short term. And I will have a fairly high cash exposure for quite a while until we get what I like to call the setup. The setup, capitalize and in air quotes. What the setup is, and I've talked about it a few times, is you see a cluster of DIX prints that's like a 5-year high, or the highest we've seen in several years. You'll see dealers, COT dealers, that are fairly heavily long. And that's not a guarantee we'll see that, because COT can be a little bit unreliable at times. But the last few times we've gotten a major long-term bottom, we did see dealers get extremely long on the index futures combined exposure. You'll see a massive breath washout, like huge breath washout, and then you will see one of the strongest breath thrusts we've seen in years. And of course, you'll most likely see price have pulled back quite a bit, pretty substantially, a pretty substantial sell-off prior to all this. That is the setup where you can get long and stay long for years and just trade around that position. And that's what I've been doing, and that's what I will do when that setup appears again. And that's what I'm going to continue to do until I see a lot further evidence that we're entering a regime change. And we're not there yet, but I think we could get there next year. So, and when I see the signs, I'll definitely let you guys know. This is dealer exposure, and what I was talking about with the setup is this. 2015, 2016, look how long they got. This is 2012, 11, somewhere in there. Yeah, I guess it would have been 11, late 11. That's the setup on the dealer longs. Now on DIX, you'll see the same thing. You'll see massive cluster of very high prints on DIX. Right now, and then the other thing is, another long-term potential warning sign is when dealers suddenly get very short. And they're not quite there yet, although yes, we're getting there. We are getting there. We're not quite there yet though. And yes, it can be very early. It was very early in that instance. The other thing, this chart, I mean, it's limited because it only goes back a few years. But there was a big give up from the index options on hedging after we got the big dump. Everybody thought we were going way lower. I couldn't tell you how many people thought this is just the beginning, we're going way lower. People were telling me this left and right, and we got this huge ramp instead. And you got the setup that I talk about. The setup happened here. The setup also happened here in a very big way. And you've had it previously a few times. But after they got destroyed on hedges, they gave up on hedging. And then they did eventually start to hedge because we were melting up pretty hard early 2020. They did eventually kind of hedge again, but then they gave up right before the real sell happened because they got destroyed again on their hedges. So I do think you'll see this come down in here at least briefly before a bigger sell-off. I think there's, well, like I said, it doesn't have to happen, but I think that would be one further bit of evidence should that happen. That's something I'm watching for along with everything else. The other thing that I'm watching for, and we don't have to have it, we might not see it, but VVIX, the vol of VIX, it's refusing to get under this line here, basically. And the reason for that is every single micro dip along the way, VIX pops pretty aggressively, and definitely did again here. Pretty aggressive pop on VIX, got up to like 26. Is that how high it got? Jesus. Yeah, just on this little 5% dip, we're seeing huge pops in VIX over and over again. And I'm not saying we'll have to see 2017 levels of complacency on VIX. I'm not saying we have to see that. I'm not saying we have to see anything necessarily, but I do think there might be, if you start to see VVIX print down here, if you start to see VIX kind of print down here for a bit, given the backdrop, given the valuations, and given that the Fed is going to start raising rates, that might be all it takes to be enough evidence that people have given up on hedging on every micro dip, and that will set up real fat tail risk of a real sell-off that suddenly, when you get the big volpocalypse type of sell-off, it instantly forces people to change how they think about the market. Until you get that big huge sell-off, people can just comfortably just buy every single dip, and now they're afraid to buy the dip, and the vol sellers stepped away, and liquidity as a whole steps away. That sets up for a bigger sell-off eventually. So it would not shock me at all if this period here, if we do something like that over here. That wouldn't shock me. Now, I think we might go to 5,000, 5,200 before we do that. But I would not rule out 5,200 next year, followed by 4,000, which would be like a 23% pullback, somewhere around there. 20 to 30%, somewhere in there. Only if we see some of these things, I should qualify that. Hedge funds exposure, they have given up. This is not COT. People have said to me that they think this is COT. It's not. It's right here. Compares the index of hedge fund exposure against returns in the S&P 500 to see how much exposure hedge funds appear to have to the stock market. So it's comparing their returns versus the S&P 500. And when you do it that way, you're accounting for hedging, which a lot of times they hedge via futures. You're accounting for hedging in theory when you do it that way. And I think, you know, a big warning sign is if Q1 next year you see this again, or certainly if you see this from hedge funds, that would be a big warning sign to me to not necessarily sell, but what I would do is I would drastically tighten my stops in that scenario. And I would, and I've said this, I guess, in the Discord, I don't know if I've said this on YouTube, but the way I trade with these longer term trades is I analyze all the data and I set lines in the sand, basically, where above this line, I'm long, below, I'm cash. And that's how I'm going to do it, but I'm going to do it much more aggressively. And I might even do a scenario where if we're in a true melt-up, I might say above this line I'm long, but below this line I'm short. That might be how I handle that. Because ultimately, price has to be the final arbiter, because no matter what analysis you do, there's a percentage chance that that analysis will not be right. So you have to sometimes let price tell you you're wrong, right? And with the line in the sand concept, what I do is, you know, I get whipped around sometimes around that line. So I'll sometimes have to go to cash and then get back long. Go back. Sometimes I have to do that. But it's not like it goes under the line I immediately sell either. I do allow for stop loss hunts to happen because the market loves to hunt stop losses. In fact, I think a big part of this market moving around, or any market these days, is just liquidity seeking algos looking for stops. And I think the big players just know where the stops are anyways. They just see the stops. I mean, I don't think legally they're allowed to see them, but we don't know what happens at these big investment banks. I'm pretty sure they get access to all sorts of information that they probably shouldn't have. So, I mean, there's not enough liquidity to go around, I think, for all the big players in the market. So they have to go find that hidden liquidity. Hidden liquidity in quotes, because it may not be hidden for them. And that liquidity is the form of stops. And a lot of times not, you know, it's probably not retail stress. It's probably other institutional trader stops. DIX has yet to do any sort of bearish setup. There's no DIX-GEX sell signal 1 or DIX-GEX sell signal 2. DIX-GEX sell signal 1 from Stephen Harlan, who has started posting on Twitter again. Frankly, I don't put much stock in that one, but when the 2.0, which is the one I created, appears, the odds are significantly better of a pullback. Still not super high. But if you combine that DIX plus GEX sell signal 2.0 with something like S&P 500 and VVIX correlations on the 5-day correlations being positive, you combine those two together, which we did have prior to this September sell-off, then you have actual edge to take medium-term shorts on the S&P 500. And that would be another thing, even though these are both shorter-term kind of signals, that'd be another thing we could potentially see. In fact, I'm pretty sure you'll see some very, very, very low DIX prints prior to a pretty major top getting put in. Another thing you might see is yield curve inversion. There's lots of different ways you can look at it. This is the 10 versus 2, which is a lot of people look at that. Yeah, 10 minus 2. And this inversion has been fairly good at preceding weakness, although it can be extremely early. Did happen prior to 08, but it was very early. And it happened in 19, mid-19, which was what, about 6 or about 8 months early maybe. So we definitely don't see an inverted curve yet on the yield curve. This is just treasury yield curve. Yeah, so, but you might see, at a minimum, you might see this approach zero. It might not even get there, but you might see this approach zero before a major issue. So right now, this isn't an issue. And this is something that's pretty reliable before really major things happen. Another thing you could see, don't have to see, but you could see, corporate yield spreads. So what this is high yield spread compared to the treasury curve, or compared to the treasuries. So high yield corporate bonds are your riskiest corporate bonds versus treasury bonds, which historically are what's known as the risk-free rate, because corporate bonds have never not paid out historically. Now, perma bears will tell you eventually they're going to default and never pay anybody, but I don't think that happens. So anyways, when this is very low, in general, there's no issues in the credit markets. And sometimes, not always, but sometimes this does start to tick off of very low levels and start to tick up before problems. We saw it. We did see it before the 2020 stuff. We definitely saw it before 08. And leading up to 2000, that was a much different time in terms of rates. But it was in a definite uptrend then. We're seeing no warning signs right now from this. Doesn't mean we have to see a warning sign before major trouble, but that's one thing I'm watching. When this starts to tick up, I'm going to start tightening stops a lot more. That'll be one thing I'm watching, of many. Okay, we're back to the beginning. So yeah, that's it. Just wanted to go over like some of the longer term things. I still think people are prematurely bearish. I still think upside is more likely than downside going forward through the next few months at least. And that's where we're at. Any questions, let me know. Thanks.